Hello, everybody, and welcome into Commodity Culture, where we break down commodities, markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm thrilled to welcome Josh Young to the program, the author of Bison Insights and the CIO of Bison Interests, a company that focuses on opportunistic investments in oil and gas equities. Amidst tariff threats and trade war woes, the oil and gas sector is being beaten up, abandoned, and left for dead. But for contrarian investors, that's often the best time to enter the market. Josh argues that as gold and silver rip to new all-time highs in a parabolic fashion, oil could be the next commodity to go on an epic run when the market least expects it. We dive into his thesis for the oil and gas sector, OPEC+, Saudi reserves, the decline of oil production in the US, and why natural gas could be the next major beneficiary of the AI race. All of this and so much more ahead in my conversation with Josh Young. Josh Young, great to have you back on Commodity Culture. WTI dipped below $60 and oil-related equities took quite a beating in the aftermath of Trump's 100% tariffs on China announcement. We're still at around $58 WTI last time I checked. Now, the tariff threat has since been walked back, and we've seen some recovery in the broad market because the broad market also fell off a cliff for a very short moment in time. Why do you think oil stocks and the WTI price dipped so hard on that announcement? And from your own perspective, are we in a buy the dip moment when it comes to the oil and gas sector, or is this a sign to perhaps proceed with caution?
Yeah, I think it's a great question. And we were sort of joking off camera that we don't know, even if it's a 1 day delay between now and publication or whenever people hear it, there's a good chance that there will have been a further trade war announcement and potentially a trade easing, all within a 24-hour period. So my record of predicting what Trump will do in any given 24-hour period remains, as Rick Rule would say, unblemished by success. So I certainly hope no one will rely on me for that. Look, I think we're in a tough situation for the oil market right this second because we have OPEC ramping volumes and we have demand coming off, seasonally coming off, but OPEC ramping sort of secularly. It looks like we're at over 2 million barrels a day more OPEC oil export volumes now than we were at the start of the year. And so that's a really significant increase. And I think the real question isn't, hey, why did oil go from 60 or 61 to 58? It's why is oil, when there's this degree of measured oversupply, at 58 and not 40? And I think there's many answers to that, and there's a lot of complexity, but I think it's really remarkable that we're at this price point, and I think we actually could end up seeing oil go a lot higher when everyone's looking for it to go down because of some of the dynamics that are keeping the price here and haven't reset them a lot lower.
Well, gold and silver are both ripping to all-time highs. You posted on X recently, first gold, then silver, then oil, ? Now, I personally believe that the oil price will eventually break out to a level that will surprise a lot of people, but of course, timing such an event, very tough. Do you think we could be on the cusp of a breakout in oil, as you were alluding to? Perhaps people will expect it to go lower, but it will go higher instead. Do you think we could get back to all-time highs again, at least in the near to medium term? And what are the main catalysts that you think could bring us there?
Yeah, so I've been, one, from a social media perspective, it's great to talk about whatever the thing is, whether it's meme stocks or mining stocks or whatever. So it's just helpful in terms of engagement. And then also, I think, framing, if everyone's in a certain mindset, if everyone's really focused on AI, I think it makes sense to try to think about, hey, how is my thing related to that or not? So there's a little bit of sort of just a pure sort of marketing aspect to that. But for metals relative to oil, there's sort of two big components. So one is a technical one, which is just when you look back at history, for whether it's because of an inflation type theme or whether it's because of fundamental demand or some other thing, you've generally had gold and then other precious metal prices rise either in concert with oil or in a sort of 12 to 18 month lead to oil. So that's just been an observed phenomenon over the last 100+ years. You've seen those sorts of price movements, and they've been particularly accentuated in the time frame from the late 60s, where you saw gold prices get unpegged. So there was a period where the price of gold was fixed. So obviously that, and also frankly, the price of oil was sort of fixed by the Texas Railroad Commission and some other folks. And so in this unpegged era, we've seen a really close link between those prices. So there's been a technical relationship where there's been price movements with a very high correlation and just sometimes lead and sometimes concurrent. But then there's also a fundamental relationship. And we've been doing some math on this and trying to figure out a better estimate, but I did plug this into AI. I asked Grok, hey, how much oil demand could there be? How much incremental oil demand could there be in a commodities bull market, in a gold and related metals bull market? And Grok came up with an estimate of around 800,000 barrels a day of incremental demand in a bull market. And that would be on a sustaining basis, not even on a new mine construction basis. Based on the current amount of consumption, I think they estimated a little over 2 million barrels a day of sustaining natural resources extraction demand for oil. So some of it will have to do with, hey, is there an iron ore bull market coming, or there's some other sort of very oil intensive commodities that are going to surge or not. But even if it's just gold and just related precious metals, and now we have the whole sort of PGM group, the platinums and palladiums and so on, which are very oil intensive to mine and very hard to get, and you get very small quantities when you do mine them. So you have to, as the price goes up, to get enough of them, you have to spend a lot on energy in order to do that. I think there's this potential fundamental demand wedge that's coming for oil, likely associated with mining. And if you look at the price, you'd say, hey, well, why hasn't it happened yet? But if you look at the stocks and then look at the share issuance activity, anyone following these miners sees it's basically like 1 or 2 offerings a day at this point. And some of that's for exploration, but some of it's starting to get bigger, and you're starting to see some M&A, but also some larger offerings that are likely going to be linked to mine development or mine expansion. And so, I think that's where it starts to get interesting. There's this technical price phenomenon, which historically I don't really rely on. It's just interesting to see. But then there's the very likely demand incoming. And when I look at the different sort of projections and analysis from banks and consultants and whatever, I don't even see the line item for natural resources extraction. Typically it's in like industrial demand or sort of bucketed in different categories. I haven't seen a single report yet. And maybe I've missed one or two. And, hopefully one of the benefits of doing these sorts of things is getting to hear from your many, many followers if I've missed one of these reports. But there's a reality, which is that it does look like in the consensus forecast for oil demand, there's this wedge that's missing directly from higher gold prices, higher silver prices, higher other precious metal prices, and then potentially some other commodities that are moving in concert. So both technical and fundamental.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Well, help us unravel how OPEC Plus plays a role in the oil market. You mentioned that they were increasing production. We hear all sorts of reports coming out of the mainstream press when it comes to OPEC Plus, and they're always talking about generally how bearish what they're doing is for oil prices. How should investors in the sector be wrapping their heads around the role that OPEC Plus plays in the market? Is it something that people should be focused on? Do you think most of the facts regarding OPEC Plus production is more noise than signal? How can we understand this part of the market?
It's a great question, and I think the reality is that it's been shifting. And so when OPEC first announced that they were dramatically increasing their production quotas for this group of 8 that had allegedly voluntarily reduced their production. Again, it's so weird because of the way that they've sort of, some of the semantic stuff is strange, but basically OPEC, a set of OPEC members cut production, and now they're adding it back. When they first added it back, it sent oil prices down, particularly because that came nearly in concert with the Liberation Day tariff announcements. And so there was sort of this 1-2 punch for oil and related equities. What we saw shortly after that was that OPEC actually didn't add as much production back to the market as they said they were going to from this group of 8 countries. And so it appeared that maybe the strategy was just to increase their quotas, but not necessarily actually increase their production. So that was true for a period of months, and now it appears that the production is starting to catch up with the quota increases. So there's just a reality, and when those volumes shift, I think it makes sense to absorb that and process it and sort of share, to change one's mind or view on this. So I still think the most likely thing that OPEC does, based on Saudi fiscal and balance of payment break-evens, as well as the fiscal needs of some other major OPEC countries, and OPEC plus countries, which appear to hold the bulk of spare capacity in the system, I think what they're trying to do right now, based on what I know, and again, this could change and we'll see, what I think they're trying to do is bring production up to the point where, one, the market rejects it through sort of a disorderly sell-off in the price, which we sort of saw in April, but that was more towards the Liberation Day sort of potential massive trade war, I think, than OPEC volumes. And then 2, to be able to reset their quota levels to a point that matches actual production capacity. So there's been a lot of claims around spare capacity and so on. And I think there's a lot of warranted skepticism, given that when they've had volume-related price wars, like in 2020, there's only a certain level of production that could come on. And then from the Saudis, for example, that production came on along with significant decreases in their inventories, both locally and offshore. And so there are real questions, including analysis that I've put out historically on OPEC plus spare capacity. And again, that is a moving target because countries do invest, and their local companies do invest in adding production, and then in some countries, and then in other countries, they've underinvested and sort of seen their capacity deplete. And so I think OPEC's trying to sort of test the limit on demand to see where demand breaks, and then sort of how much oil can get absorbed into the market. And then they're also trying to reset their quota levels. And then I think once we've sort of accomplished one or both of those in the oil market, and that could potentially happen pretty quickly, or it could happen 6 months from now or so on, they've said in every one of their announcements on these production increases and sort of, I guess, technically OPEC group of 8 quota increases, that if inventories rise, or sorry, they were increasing them because they were measuring global inventories and global inventories were low. So, and it seemed important to them to say that. So at a point where they don't say that, my expectation is that they would pull back production, having accomplished sort of this market test and the ability to navigate internal politics on just who actually has the production capacity and who doesn't, to be able to set quotas in sort of a more reasonable way. And one reason to tell, I think, that this is a likely path, in addition to observing their behavior and having met with them and talked to them, all this stuff, is looking at the financial situation for Saudi Arabia, for Russia, for some of these other countries, and seeing their need. I mean, Saudi Arabia really needs $90 plus oil just to break even. And their fiscal demands are rising every year because they run a social welfare state where a large number of the people receive money directly from the government or government employees, or, government owned company or government sponsored company employees. And their population growth is really rapid. Their demographic problem is different from our Western demographic problem. So anyway, that's why I think when you look at it, could they sustain low oil prices? Yeah, but I think they look at today's price as actually quite low. And I think they need and want prices a lot higher. And there is this weird theory, oh, hey, they're going to fix that by producing another 500,000 barrels a day or something and selling it. And the problem is that as they increase volumes, they decrease price. And so their net increase in profits in order to fund their welfare state actually doesn't increase by much. And so they do much better by actually producing 500,000 barrels a day less and achieving, let's say, a $10 higher oil price than they do producing 500,000 barrels a day more, let's say, and achieving a $10 lower oil price.
Well, I was going to ask about the oil production situation in Saudi, but you've basically addressed that. So I want to move to the United States. Traditionally, in recent history, the world's largest oil-producing country. 2023, I know that they were number one. But yet there is contention by a lot of analysts, I believe yourself included, that those production volumes are starting to roll over. We are starting to see issues in the Permian Basin, particularly with shale oil. Walk us through that, because I think there's a little bit of recency bias in the market that people believe what's happening today will continue to happen tomorrow. What is your current outlook on future U.S. oil production?
Yeah, I mean, I think it's even debatable how much oil is being produced right this second. And so people have different outlooks on this based on, I think, what they're measuring and what they're seeing and what they're even tracking for some historical measures over the last few months. And I know it might sound weird to people listening to this thinking, hey, well, oil's physical, so how can you not know how much oil is being produced? But when you look at the different measures, and then you look at the government data, I think we've seen a lot of revisions in government data across sort of a number of different categories. And so whether it's politically motivated or whether it's just purely related to the calculation methodologies that the different government agencies are using for their economic data collection, processing, and reporting, I don't think the government data in this case on oil production is that reliable. And some of it's actually just modeled. So it's okay, you can just take their formula and then sort of back into what they actually measured and when they last measured it, as well as what the revisions are. The reason to sort of go down that rabbit hole is that there are other data providers, such as I shared on social media recently, TGS, which does a lot of seismic and then subsurface data analysis and processing, that are showing very different numbers. And then when you look at refiners and you look at some of the other sort of parts of the oil sort of value chain and complex, there's some evidence that you're not seeing quite as much crude oil delivered as is in the government numbers. So why does that matter? The question is, are we producing 13.5 million barrels of oil a day right now of crude oil? And then are we producing about 21 million barrels a day of crude oil plus natural gas liquids? Or are we producing a little less, or are we producing a little more? If we're producing more, that's very bearish, because what that could mean is that we've achieved such incredible efficiency gains in shale development that we're going to see growth at even lower prices, and that could force an even lower price in order to sort of clear the oil market. That would be a very bearish scenario. There are some folks that are observing that or claiming that. The most prominent one looks like it's based on natural gas volumes, but I don't think that's a great measure for a variety of reasons, including that the wells are getting more gassy. When you drill a shale oil well, you typically get some gas production, and that percentage has been growing over time. And so I think there's some noise in that analytical approach. The surprising thing to me has been that you have the TGSs of the world and some of the pressure pumpers, so some of the companies that actually achieved some of the best efficiency gains to date, especially in the last couple of years. And those are the companies that are pounding the table loudest. Some of their CEOs are active on social media, other, X and LinkedIn and whatever, like sharing their analysis, forecasting production declines and claiming that the EIA is wrong. And where I've missed this, right? I thought that shale production was going to go into decline a year ago because the rig count had fallen, and I had missed some of the efficiency gains. I've subsequently gone down that rabbit hole a lot. And actually now I own a bunch of drilling rig stocks because those gains are very much in the past, and the future demand for drilling rigs, I think, is going to be a lot higher than the current demand because of that trend. So the pressure pumpers were the next beneficiaries. Them looking at this and saying, hey, there's not enough oil and these numbers are wrong, I think is a phenomenal signal. And it has me with a tinfoil hat on a little in terms of the government data, because I think that shale probably is being overreported right now. It doesn't mean that there isn't a small oversupply in the oil market because of increased OPEC volumes and various other dynamics. But shale is not the contributor to that. We're already seeing it looks like production declining. And again, that's sort of the way to lay it out. And I think it's important to remember that there is some controversy on this, and there is a possibility that somehow the pressure pumpers and the drilling rig guys and the producers and the subsurface guys and I are wrong, and that the government data is right, and that there's been this extra production growth despite a rapid decline in rigs and a dramatic decline in pressure pumping, which is the fracking activity to actually be able to stimulate production from shale wells.
Let's talk about Venezuela. Massive untapped oil reserves there, and looks like the Trump administration is angling for some kind of conflict with the country. They've, I believe, destroyed 3 boats they claim were carrying drugs to the United States. I don't believe they've provided proof of that. We just kind of have to take them at their word. And now they're talking about potential strikes within Venezuela itself. I don't think the war on drugs is going to work, as it has failed spectacularly in the past. But I also don't think that's why they're doing this. I think part of it is for political, ideological reasons, to get a regime change, to kind of reassert American hegemony, which is in question for a lot of people right now, and perhaps to access all of these vast oil reserves. I wonder what your view is, first of all, on the reasons. Do you think oil has something to do with why the Trump administration is ramping up against Venezuela? And in the situation where we get a successful U.S. invasion, whether that's boots on the ground or through some other means, they get a regime change, they end up getting access, and they start producing from those vast untapped oil reserves, would that be a bearish scenario for the oil market?
Yeah. So first of all, this is sort of pretty far outside of my area of expertise. I know a little about Venezuela, but not enough to be able to sort of have a strong view. My view on U.S. oil production is based on, deploying historically over my career hundreds of millions of dollars into oil and gas producers and services companies, and having close relationships with this whole sort of network. And even getting that right is still really hard. And there's still lots of questions. And frankly, everyone, including me, has been wrong on that in both directions for the last several years. So just I think there's a certain amount of humility, I think, that goes into any sort of forecast about the future. And so with that being said, I think I actually think it's wonderful that the U.S. is sinking boats that allegedly are full of fentanyl or whatever. It's terrible, the impact that those drugs have had on American communities and the American lives. Many people have died from this stuff. So to the extent it's true, wonderful. And hey, maybe we should do a little more of that, not just focused on Venezuela. Is the focus on Venezuela because of the oil? I think oil is a contributor to that interest. I do think that there is this interest in sort of maintaining, I forget the term, whether it was the Monroe Doctrine. There was some idea that we would basically try to control the Western Hemisphere to some extent. And so I do see that being more of a sort of Trump administration type thing, maybe even more than caring about the specific oil in place there. And then the logistics of that oil it's quite challenging. So a lot of it's heavy oil. There's huge environmental issues in Venezuela right now. I mean, people complain about a tiny amount of oil dripping into soil in North Dakota or whatever, or West Texas. There's all this controversy over a little dirty water, but it's weird because you look at it and it's like wasteland that it's spilling into. So it's like, hey, did you actually sort of accidentally clean some of this surface soil by having some brine come out in West Texas? But in Venezuela, it's really, really bad. And so the reason to highlight that is that it's so bad that it's going to cost a huge amount of money and take an enormous amount of time to materially increase Venezuelan oil production. And it's going to take a lot of investment in terms of fixing infrastructure. You'd think that there's pipelines in place, but a lot of those pipelines have big holes in them. In some cases, people are stealing the oil. In other cases, they just didn't maintain them well or what have you, or there was sabotage. So we've already seen, we've already seen oil production rebound in Venezuela somewhat from the Trump administration and the Biden administration providing waivers and allowing companies like Chevron to come in and do some small elements of this. But I think they already hit the very sort of easy, low-hanging fruit. And I think going from, let's say, 1 million barrels a day to 2 million barrels a day in Venezuela would require an enormous amount of investment and time. And maybe it's me being too much of an optimist, but I see there being way more incremental demand in Venezuela for oil to the extent that there's a turnaround. I mean, if it's just the Maduro regime continuing their oppressive communist, regime, continuing their, horrible negative economic growth, but then also, bringing in American companies to produce more oil, that would be negative for the oil market. But if there was a full sort of regime change, and if there was a opening, sort of like what we're seeing in Argentina, where you saw, whether it was forcible or hopefully peaceful, I think you'd actually see a lot more oil demand in Venezuela. There's a lot of people there. There's a lot of people that left there that I think would go back if it became more of a free country again. And so I'm not sure. I actually think you could end up seeing the short to medium term impact on oil being bullish for oil prices because of the surge in demand. And in the long run, obviously, it would be bearish for oil because there is a lot of oil to address, to produce from Venezuelan reserves. I just think the process in between now and, let's say, the 5 years from now, let's say tomorrow there was a regime change, the next 5 years would be very oil intensive, and there wouldn't be a lot of incremental oil production to offset that. So that's how I think about that. And maybe it's a motivation for the Trump administration, maybe not. I don't know, hard to tell, but I think the economic development aspect, I think people forget because they've seen what's happened in the US and certain other economies where once we got to a certain level, economic growth was was much less linked to oil consumption. But that move from, starvation level to reasonable level of lifestyle is enormously oil intensive, especially in oil producers where there's a big incentive to subsidize oil consumption for their citizens.
Yeah, that's a very good point. I hadn't considered the angle that those hydrocarbons would be very much needed by the citizens to improve their quality of life. This question's a bit off script, and maybe you won't have any particular insights, but I'm just curious what your thoughts are on the demand for hydrocarbons driven by global conflict. Does this really play any part into the equation? I know that these days it seems we're moving more and more towards drone-based warfare, so I imagine that's far less oil-intensive than driving tanks across borders and firing weapons of mass size like that directly. Have you ever thought about how war worldwide potentially impacts oil demand? Is that even something that one needs to factor into the equation, or is it so negligible that it's just off of your mind?
Yeah, it's funny. Here I am thinking about being very ambitious with my, potential 800,000 barrels a day of oil demand for mining activity. So, for conflict, yeah, I mean, very fortunately, it's been a very long time since there's been large scale tank warfare. I guess we saw that very briefly in Ukraine when Russia invaded, but for the most part, that sort of thing, it's been a long time since that's been a real factor. So I actually think war is mostly negative for oil demand because you end up with less civilian activity, and it's one of those like weird paradoxes where when you look closely at gasoline demand for holiday weekends in the U.S. There's this concept, and like I had this mistaken concept a while back, where holiday weekends were actually good for demand. They're not. They're really bad because days that are spent by the lake or by the beach or in the mountains or whatever are not days that are spent commuting to and from work. And so, yeah, there's a little extra jet fuel demand from flying places, but the actual, in the holidays, the last 2 weeks of December, the total oil demand is actually not as high as you'd think. And then, Labor Day and Memorial Day and so on, you have people drive to and from where they're going, but they're just day-to-day structural oil demand is so high that disrupting that actually sort of can end up being either negative or there's an incremental positive, but it's much, much less than you would have thought for a whole bunch of people hopping on planes or, sitting in traffic for 8 hours to get to some place. So similar dynamic, I think, for warfare where, especially with this move towards drones, but in general, you just haven't seen the sort of, I think people think of war as World War II, where you have, tens of thousands of tanks driving back and forth and trucks and whatever. And without that, fortunately, we've moved away from that to the. I mean, it was just devastating from a humanitarian perspective, but it's just not as material from an oil demand perspective as you would think, and hopefully there's less of it. But the one aspect I think that is worth touching on that I think doesn't get enough attention, and actually it looks like this morning, and maybe it was at a conference in Asia last night or yesterday, the head of Vital was talking about how there's relatively low geopolitical risk priced into oil. How they said too low, and some people are saying, oh, it's actually negative. And I think I agree. I think there's a base level of oil production disruption where you have about 2 million barrels a day over the last, let's say, 20 years that's offline for various geopolitical reasons. And sometimes it's 1 million barrels a day, and sometimes it's 5 million barrels a day. So 5 million barrels a day, you got that April or March of 2022 level where you had oil prices go up $50 a barrel in a month because you had so much oil production come off because of geopolitical risk and oil supply disruptions. Right now, you're close to only 1 million barrels a day off because of geopolitical disruptions. You have near record highs from almost a decade, I think, from Libya. You have Iranian exports at 7 or 8 year highs. You have highs in various other spots. And so I think the risk is that there's some amount of disruption associated with that. And that would be where I'd look for more on the geopolitical side rather than, demand for tanks or something. And then also, I think there's always this hope that we're going to come in and transform a country and nation build and so on. And unfortunately, that didn't really work for us in Afghanistan or Iraq. It probably wouldn't work to some extent in Venezuela. I think the Malays of the world are way better where, hey, you can come support them, send 0 bullets and, send a little money. And even that got a lot of controversy. But, I think that sort of thing is wonderful and can work. But even that's really hard. So I think the base expectation from a geopolitical perspective probably is just additional supply disruptions at some point. And again, speculating on which exact ones, I still think Iran has a decent shot, whether someone eventually enforces sanctions or whether they've just funded and sponsored and trained all kinds of different violent activity across the Middle East and beyond. And so when you do those things, they're disruptive for your enemies, but they're also disruptive for you unpredictably. And so I think, Iran could be a leading cause of supply disruption, whether it's their supplies or other people's supplies, but it's possible that their supplies disrupted from many other places. And then, as I said, just the one other one that's obvious is Russia's energy infrastructure has been hit repeatedly by Ukraine recently. And we've actually seen more oil exports, but less processed diesel and gasoline oil product exports from Russia recently. And so maybe we end up seeing more of an impact. We'll see. But even that would be sort of small. That might be a few 100,000 barrels a day of impact versus, I think, just historically, just the number is about 2 million barrels a day. And we're 1 million lower than that approximately right now.
Well, let's end by discussing natural gas because there's been a lot of focus on AI data center usage and how much power they require and are projected to require moving forward. Natural gas seems like the obvious beneficiary of a ramp up in data center builds. Would you agree with that? And how much of a tailwind do you think the AI race could be for natural gas markets?
Yeah, I think the real question on it is what happens if it ends? And and I know that's sort of like a weird negative way to respond to that, but the demand from it right now and the current trajectory for natural gas demand is astronomical from AI. And I think actually most of the estimates I've seen have been low on it. And I was frankly low on it even at the start of this year. I thought that there'd be this great bull market for North American natural gas kicking off mostly from exports of LNG. And actually, a lot of that LNG will end up getting used in countries that are building out their own AI data centers, weirdly. So right now, though, the demand growth for AI data centers for natural gas, let's say looking out a year based on current construction, is almost 50% higher than it was at the start of the year looking out into that same time frame. You just look at the size of these projects. the speed at which they're being announced, and then the expansions of, so, what would have been a 1 gigawatt project is now going to be a 2 gigawatt project. And, what was going to be a 10 is going to be a 20. And the dollar amounts are rising. And then the chip energy intensity is rising. So until that stops, and we'll see, right? There are folks that are saying, hey, it's totally uneconomic, it's going to stop now. There are others that say, hey, it's worth it. Even if it's uneconomic, it's worth it, or it's going to be economic for various reasons. I don't know, not my area of expertise. I can just observe what's happening and what's getting funded. And it looks like there's a lot of demand in the bag for natural gas from AI data centers. And some of the constraints, the physical constraints, are being mitigated. So there weren't enough gas turbines. So the turbine producers are all ramping up their manufacturing and assembly lines. And then there's some other folks in China and various other places that are sort of ramping up their manufacturing of gas turbines. And then there's other technologies you can use that are less efficient, but that still can get you power sooner. And we're seeing some of the sort of, older generation technology, power gen from natural gas getting used a lot, and because of the short-term turbine constraints. And then you're also seeing some moves where there were some power plants that weren't running at full utilization, full capacity, start to run. The just base demand is rising, and some of that's Bitcoin mining or other crypto mining, and some of that's the additional data centers coming on that are starting to pull electricity away from various other spots, or starting to pull utilization rates higher. And as you pull those rates higher, there's the demand intensity for gas rises a lot, because there's been some replacement of demand by solar and wind, and some from actually mostly just solar and wind. And so as you go from, let's say, 80% utilization to 90% utilization, 100% of that will be from natural gas, or 99% plus like a little bit from batteries. And so as you get that pull up, it's not just the new big data centers in West Texas, it's also, various smaller ones getting built in various cities and states around the country in the US. And then similar internationally, I actually think you're going to see the chips in China look a little less energy efficient. And so they're making up for it by volume. And so there's all of this. Everyone talks about the number of nuclear plants built in China, the number of coal power plants, and that's wonderful. And they have a lot of spare electric capacity right this second, but it looks like they're set to absorb that and then some. And again, I don't know when this stops, and I don't know that anyone really does, but for right now, it's like a weird number go up, but number go up at a faster and faster pace sort of dynamic. So that does seem inherently unsustainable, but for right now, the demand is growing really fast. And so I'll just address the obvious, which is, hey, that sounds great, Josh, but the price for natural gas is $3 an MCF right now in the US. What's going on? And so there is a seasonality component to natural gas prices in the US, and there's a weather component. And so similar to that geopolitical risk where oil disruption is about 2 million barrels a day on average, but right now you're at 1 million, and sometimes it goes up to 5. Weather demand for natural gas, there's an average, there's a typical, and then there's variation, which is just normal. It's not necessarily climate change related or anything. It's just, sometimes Octobers are very cold and sometimes they're very warm. And depending on where it's warm or where it's cold, that could drive incremental gas consumption or less gas consumption to an order of magnitude more than sort of the current levels from data centers. So the data centers are getting built really fast. LNG export facilities are getting built really fast. But the recent moderate weather in the last month or so has really crushed that recent sort of move higher in natural gas. A year from now, as you have a lot of these come on, the weather may matter less, and weather may matter more in terms of, hey, are you at $4 for gas or are you at $6 for gas? But right now, because of the relatively small size, weather is still playing a really big component. So, it's one of those weird things where it's coming and it's already priced in to some extent into the forward curve for natural gas, but the spot price is still very low. And just the last comment is some of the companies that benefit from this, the service companies, the producers, some of them are pricing in a very high natural gas price, especially some of the bigger, more liquid stocks. And some of them are pricing in $2 gas because the small cap investors are burned on their 10th go around on whatever. And so I'm the busiest I've been in a very long time. And there's this really great sort of set of potential opportunities, both on oil, but also particularly on natural gas, where there's this consensus view on gas, which is bullish. And then there's the view that's getting priced into equities. And there's just such a variation in terms of, you have companies that are pricing in that are big, very big, that in S&P 500 or close to that, that are pricing, let's say $5 gas, and then others that are pricing in literally $2 gas. So it's a very exciting, very interesting dynamic for gas.
Excellent insights, Josh. For those who want to learn more, dive deeper into your work in the oil and gas markets, tell us about Bison Interests and Bison Insights.
Sure. Yeah. So we've been running Bison Interests for a decade. We invest in publicly traded small cap oil and gas producers, and to a lesser extent, services companies and infrastructure companies and so on. And earlier this year, I launched Bison Insights, which is a media company and newsletter. And I use that I get asked every day, hey, Josh, what are your favorite oil stocks or gas stocks or whatever? And it was a way to, in a compliant, organized manner, sort of answer that question and share an idea or two a month and share some other stuff. And actually, it's been fun. I've gotten to do a few expert interviews, much less sort of broad consumption focus, much more, hey, I have this question about this topic on my research on this thing, and let me go find the expert in that, whether it's a CFO of a company or whatever. And so it's been a little fun to be on the other side of the camera, although the broad stuff I'll leave to the experts like you.
Awesome. Well, I'm going to put links in the description below to Bison Interests, Bison Insights, as well as your profile on X, because you do post a lot there as well. Josh, once again, thank you so much for coming on the show.
Thanks for having me.
Thank you for joining us today. Our sponsor, ARC Silver Gold Osmium, has some great prices on gold and silver bullion. They are on screen right now to take advantage. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And be sure to pick up your Commodity Culture merch, all backed by a 100% quality guarantee. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.